Grazie per essere.
Good evening, ladies and gentlemen. Thank you very much for attending this meeting. It's a Saturday afternoon. We have a beautiful weather. Let me introduce Professor Olivia Mitchell, who has dealt with pensions problems throughout her life. She teaches at the Wharton School, part of the University of Pennsylvania, and she also the director of a research institute dealing with pension issues, and she has been the member of many governmental commissions in the US, and she has been very much looked for consultant. She wrote many articles and books on very interesting subjects. For example, 3 reasons why your boss should keep you at the workplace after the age of 60, or how boomers can act now to repair their nest egg. So what's a nest egg? Well, the nest egg is the real treasure, the money you put aside for the time of retirement. It's an idea which is unknown in Europe. In Europe, the central governments guaranteed pensions and protections against the risks of losing pensions on part of the elderly people. So when there is no state there, there are problems, because on the one hand, we need a plan to build a pension for the future. We need to be aware how to invest, how to plan our lives. And when the pension is accrued and the person retired, there still are problems, because there are still many risks and many decisions to be taken. And she is going to speak about that. Thank you. You have the floor.
Good afternoon, ladies and gentlemen. It's a very great pleasure to be with you today in Italy and in Trento. And I thank very much the organizers of this conference, as well as particularly Tito Boeri for including me in the activities here. It's been a rare opportunity to learn about the matters that concern Italy and the matters that concern us around the world. So one thing I would say before I start is I began working on pensions and retirement topics 30 years ago. I was 30 years younger, and it seemed like such a long way away. Now, like many people in this room, it begins to grow closer. Not too close, but closer. And it has a way of focusing the attention. Very, very different than when you're in your 20s. But my topic today is reinventing retirement in challenging times. And there are 4 questions that I will be looking at. First of all, what are the key elements of retirement risk? Second, how can individuals and their families do a better job to manage this risk? Then, going up the ladder, how can firms and financial institutions perform better to help manage the risk? And then, how can governmental and international organizations, again, serve for this purpose? Now, my background is in risk management and insurance and economics. And in especially the risk management area, you always look at 3 approaches to protect against risk. The first is always identify the sources of the risk. Second, avoid, if you can, or reduce the risk. And third, finance and insure where you possibly can. So I will talk about these three approaches in the context of the four sources of old age risk. First, individual and family. Second, pension systems. Third, political or national risk. And fourth, global risk. So let me start with a definition of what is retirement. Now, in the old days, perhaps your parents' idea, your grandparents' idea, you would stop work at some point. You would claim your pension benefit, a government plan benefit. And at least in the US, many people, men usually, want to play golf in retirement. How many people play golf here in Italy? Not too many. Okay, maybe you go fishing. That's the other approach. That's the old view of retirement. What's the modern view of retirement? Keep working in many cases. Some people think about changing career. They take advantage of a new possibility, maybe of starting a company, changing jobs, working part-time, working as a volunteer. It's an opportunity to do something different in the later phase of your work life. Now, of course, my plan is never retire and never get old. So that seems like another useful thing to think about. Focusing first on individual retirement risk management, we can figure out what the risks are. You first identify the risks. Undersaving is a huge problem. All around the world, people tend to rely on others to take care of them, and they don't save enough on their own. They also face very expensive health shocks, and then they live too long. That is, they outlive their assets. And so those are some of the risks that face the individual and the family. Two approaches, mitigation and financing. First of all, in the mitigation area is a theme I have heard in many sessions at this economic festival. The issue of investing in human capital, in your own skills, so that when you are 60 or 65 or 70 years old, someone wants to hire you because you have valuable skills and you can keep working. I know that's a little radical in Italy, but it's going to come everywhere. I would also say, even though I'm an economist, it's important to think of the social context for growing older. If you have a partner that you can rely on, if you have good children that can help you when you're old, if you have a community, a neighborhood, where maybe you help them when it snows, you help them shovel the snow, and they help you when you're gone, take care of the dog. This kind of partnership is very important to be able to let people age in place, stay in their communities, which, by the way, is much less expensive than putting people in a nursing home, in a hospital, in some other place. And of course, we also have to think about risk financing. It's a common phrase to talk about self-insuring in the West. Basically, what that means is you save for your own old age and invest. Another approach, which I'll discuss briefly, is that of insuring. That is, you might want to think about purchasing an insurance product which will help protect you against some of those risks. So, for example, annuities are products which help you avoid running out of money when you're old. Another product is long-term care, which I've written up here as LTC, long-term care, which would speak to the insurance that you might purchase in case you need to be in a community, say a medical community, to take care of you if you have dementia. So those are some ways to finance the risk at your own level. Now, of course, the life cycle model, many of you have seen this is very simplified. It would suggest that when you're young, you're born, B, you start to earn, hopefully at a rising rate, and the traditional model would say that at some point, like R, you take full retirement. This is a very schematic view, but it's just to illustrate it. along the way, ideally, you would start saving in a pension, you would start putting aside assets, maybe in your house, for example, or in the bank account or in the stock market. You would build up your savings from B to R, and then you would start drawing down your savings from R to D. What is D? That's the date you die. And if you know everything, if you have perfect foresight, it's easy, right? You save, you dissave, and you finish with €0 in your pocket. Or if you're more crafty, you finish in debt. But that is something that economists think of. But the point is that you have an orderly asset accumulation and orderly asset spend down. That's the theory. What do people do? Many people don't save at all. We know there are very big differences across country. I hear Italy is among the better savers, but in the US, we've been saving less and less over time. It's very important as we think about the new world we're entering to understand that choices are becoming more individualized, that choices are spreading to pensions, to financial markets, to labor markets, and this has many advantages. For example, people can act on private information. If I know what kind of school I want for my children, if I have choice in schooling, I can take them to a school that will provide them that education. Choice is good in many cases. It creates incentives for efficiency. Professor Hanushek yesterday, if you heard him, spoke about educational competition, where it's possible for schools to compete and thereby improve the quality of education they give. We also have now, in some places, voucher systems for medical care. You can select your doctor instead of being told to go just to one doctor. A little competition doesn't necessarily hurt. And in the case of Social Security, there has been some group of people, myself included, suggesting that private accounts might be a useful addition to the picture for old age savings. Those are some positives, but there are also some negatives. One of the issues we worry a great deal about is what we call suboptimal choice. If you give people too much choice, and if they don't understand the decisions they're making, they may make very damaging decisions along the way. And this is particularly true when you have a lot of risk, a lot of uncertainty, when the time horizons are very long, like in the retirement case. And people typically follow the path of least resistance. They do what everybody else does, or they do what seems easy because they maybe don't know the opportunities, or they're afraid, or they're not educated. So one of the threads of my research asks, how well equipped are consumers to make these decisions? And here I would like to mention some work that I have done with my colleague Anna Maria Luzardi, who's also here in the audience. And we have now offered these questions on surveys around the world, including Italy. And so I give you a small test. No grade is required. So this is a question we've asked in several countries, and it's about interest rates, and this is how we pose it. Let's say you have 200 euros in a saving account, paying 10% interest a year. How much would you have in the account at the end of 2 years? Now, we don't expect people to take out a calculator. What it's simply we're asking is, do you have less than 220, equal to 20, or more than 220? What's the right answer? Please volunteer. More than 220. If you understand compounding interest, you understand you're getting interest on interest. Very important question. If you have a credit card, you're paying interest on interest. If you have a mortgage to buy a home or to buy a car or a student loan, interest on interest. It builds up. If you don't understand this, you are going to make big financial mistakes. Second question, inflation. Imagine the interest rate on your savings account was 1% a year, and inflation was 2% per year. at the end of a year, with this money in your bank account, could you buy more than today, equal today, or less than today? What's the answer? Less than today, right. So if you don't understand inflation, then you're probably not going to do the right things about saving, consumption, investment. So you guys are really good. I'm going to ask you a difficult question. This is risk diversification. This is the hardest one, I'm warning you. So true or false, buying a single company stock usually provides a safer return than a stock mutual fund. True or false? False. You're very good today, very good. You all get A's. This is a very difficult question, as I'll show you in this next picture. This is from a survey which Ana Maria has participated in 2009, and these 3 questions were asked of people of all ages. The interest rate question, less than 2/3 got it right in the US. 21% got it wrong, and these guys don't know. These guys refuse to answer. Okay, so that's not so great. Next, we ask about inflation. Similar fraction gets it right, similar fraction gets it wrong, but by far not everybody knows. And most worrisome is the third question, risk diversification. Only half the people, roughly, got it right. And a third had no clue. Right? So if you're talking to people about saving for retirement, diversifying your portfolio, if they don't understand risk, how can they possibly function? And if you ask how many people got all 3 questions right, only 30% did. Half, less than half, got the first 2 right. So this established the benchmark that we started with. Then we proceeded to ask these same questions around the world. And so you see the very educated people, and I will congratulate my moderator here because he's originally from Germany. The Germans and the Dutch know a lot. The dark blue bar is the percent who got all the questions correct. And the black and white bar is the percent who got 0 correct. So the Germans and the Dutch are doing something right. I'm sorry for Professor Henishek, I don't have Finland, I don't know. We see that the US, Italy, Sweden, Japan, and New Zealand, they're kind of in the middle. Not so great in terms of the right answers. Italy, unfortunately, has a lot of people who get it wrong, who get all of them wrong. So here you see a big need for financial education starting right away. And then Russia, poor Russia, is in the worst situation. And that's probably for historical reasons, lack of exposure to financial markets. Some good news, since I'm a professor, as you go for people who have very little education, these are high school dropouts, to people with a lot of education, college or more, the financial literacy does go up. And this is the question on compound interest. Unfortunately, financial literacy falls with age, so the young people know more, the older people know less. Probably this is in part because of what we call a cohort effect. People who are young today were much more exposed to financial issues, whereas people today who are in their 70s perhaps were not. Differences by sex. Blue is for boys, pink is for girls, like everywhere, of course. And not surprisingly, across the questions, men typically know more. They are more likely to answer the questions correctly than women. What's also interesting, however, is that the women know when they don't know. In other words, they will say, if they don't know the answer, they tell you, I don't know. The men tell you they know even when they're wrong. So this is an important difference when we start to focus on who we can educate. Maybe the women, we have more potential than the men. So the good news is that people who are more financially literate save more, plan more, accumulate more assets. This is in a US study, but we've been doing studies again around the world. People who are non-planners, who are not financially literate, have about 1/3 the assets of people who are financially literate. And again, there's always questions about causality. Are the people smart because they have money, or do they have money because they know? We believe we've established causality quite reasonably by now. It's not enough to accumulate assets, unfortunately. We also have to make sure we don't run out of money in old age. So here we have what we call life expectancy numbers. For a man age 65, he, on average, using the life tables, would expect to live 16.4 years more. Women, on average, at age 65, 19.6 years. That's the life table. And frequently, when people are thinking about planning for retirement, they use these two numbers to target their money. Okay, do I have enough money to last 16.4 years if I'm a man? But the problem is that is very inaccurate. Life expectancy is an average. 50% of the people live longer. So if you do live if you live longer, if you survive to the right tail of the mortality table, maybe you still need to consume. So what we show here is that 36% of the men will live to be at least 85. Almost 20% will live to be 90. And of course, we know survival tables for women are even higher. 30% of the women will live to be 90. And probably most of the women in this room will live to be 100. Why? Because you're well educated. You probably have better health than average. So keep investing in your skills and your health. Don't give up. The other thing to think about is if you have a traditional couple, a man and a woman, let's say, the man, let's say, is 65, the woman is age 60, just to pick an example. If you look back in 1975 and ask, what's the probability that at least one member of the couple would live to be age 90? It used to be about 1/3. Going forward, it's about 2/3. So this is really important because it suggests that longevity risk, living a very long time, is a key part of retirement risk management. Now, the only equation I have, apologies for those that are allergic to equations. So what we need to understand is what financial products can protect us against longevity risk. And so annuities, payout annuities, not investment annuities, but payout annuities are a key piece of this discussion. So the present value of an annuity is equal to how much the benefit is every month or every year, multiplied by the probability you're alive, because you only get an annuity payment when you live. You discount this cash flow to figure out what is the expected value today of this benefit stream into the future. Now, annuities pay benefits until death. Obviously, you need mortality tables and discount rates to figure out what's the value of the annuity, and mortality has changed over time. Another key factor is that we have what we call adverse selection. People who buy annuities are different than everybody else. People who buy annuities, that is, payments that last the rest of their life, live longer. And you can see that in this figure. This is the population distribution of the age at death, given that you made it to age 65. And this is the annuitant distribution of the age at death, conditional on survival to 65. So this says annuitants live longer. Now, maybe it's because they have an annuity, but I think the more reasonable explanation is they buy an annuity because they know they're going to live a long time. They eat yogurt, they sleep 8 hours a night, they don't smoke, whatever. 1 glass of red wine a day, that keeps you going. So the question is, how important is this? And what we've computed for several different countries around the world is what we call a money's worth ratio. What's the ratio of the benefit that you can expect to the premium that you pay? If the ratio is 1, it says you pay €1 in expectation, you get back €1. Now, you wouldn't expect an insurance company to give you $1 for $1 or €1 for €1. They have to pay their agents, they have some solvency premiums, capital they have to set aside. But these numbers, especially the numbers using the annuitant tables, are pretty good. It says you pay €1 or $1 in the US, and you expect to receive back 93 cents on the dollar if you use the annuitant survival table. In Italy, it's even better. You pay €1, you're expecting to get back 96 cents on the euro. So this says these are pretty good insurance products, good value for money. If you were to compare them with other insurance products you buy frequently, like medical insurance, what do you think is the money's worth ratio for medical insurance? You pay €1, how much do you think you get back in expectation in a year? Anybody know? Not in Italy.
So it's a national service.
So it's public. You have no private insurance in Italy. So in Germany, they have private insurance. In the US, they have private insurance. And typically, it's maybe 60 cents on the dollar or on the euro. So this is a pretty attractive product. Right. So in Italy, you do have some private insurance. Right. Yeah. So I believe that go ahead.
Excuse me, we're getting to some applications of to the conclusions. If I may invite you, if you want to, you can also ask the hostess, one of the hostesses, and they will give you a piece of paper, and you send me a question also on a piece of paper.
Good.
And otherwise, you just put a question afterwards, as you like. So if you want to send some questions, just think about your questions right from now on. Thank you.
Thanks. So I believe that in Europe as well as in the US, as government pensions grow smaller, there will be an opportunity and a demand for more private annuity markets to grow. Fewer traditional company pensions, retirees now have to manage their money, and even in some cases, for example, in Germany with the Riester plan, there is a mandate that part of your retirement saving be annuitized. You must convert some of your assets into a lifetime payment to protect yourself against yourself so you don't run out of money when you're old. Okay, but there is a lot of uncertainty still about how these markets will develop. Another thing we see all around the world is that if you look at where older people have their assets, usually they try to buy a house. And this is true in almost every developed country and many developing countries as well. The concern is that older people have all their money in one house, not diversified, and it's not a good time to sell your house, at least in many countries. So there is a growing demand for a new product, relatively new, called reverse mortgage, where the older person can remain in her house, sell a piece of it to a lender, get some money back, and then when she dies or she has to move out of the house goes to the lender. So I think this is a potential product with a great deal of interest around the world. Now, there is some concern that the lender needs liquidity. The value of the home is somewhat uncertain, especially now. The person needs to keep up the house, to repair it, to fix the roof. There's mortality risk, there's interest rate risk, but it is, I think, a product which will continue to grow. The big problem, of course, is that even though many older people have their money in a house, housing is not a safe asset, as we see from this graph. This is a time picture of the decline in housing prices in the US. I think in Trento they didn't go down so much from what I can tell. But housing is certainly not a safe asset. So I talked a lot about individual and family risk. Let's go up to pension system risk and finish the ladder. So all around the world, in many countries where I work, I see that public and private pensions are facing huge challenges. What can we do? In some cases, there is pension and insurance regulation to try to protect those promises so there will be money. In some cases, there's pension financing. That is capitalization assets set aside to protect the promises so the money can be there. And some countries like the US and the UK have established solvency funds to back the pensions in the event of bankruptcy. Pensions, however, are very troubled. This goes back to the beginning of 2008. And you see from the smallest to the largest that was registered, how much assets the pension funds had in them invested in capital markets. So I know in Italy you use the word differently. Trillion is the unit that we're looking at, which is a million. So we had $15 trillion worth in the pension funds, in assets. But unfortunately, they were majority invested in the stock market. And many other countries also had a tremendous amount invested in the stock market. UK, Australia, Germany, being more conservative, fared better. You won't be surprised to see. So now, when the capital crisis occurred, you see on the vertical axis the percentage of the portfolio in equities, in stock, and on the horizontal axis, the real return, and it's negative in 2008. So we see poor little Ireland, very, very high fraction in equities, very, very negative performance, US not far off. So this is something that has served as a big challenge for the pension system that was designed to protect our retirement. What's happening now? Bankruptcy or near bankruptcy. Retirement assets have lost value. Interest rates are very low, liabilities are exploding, and the companies, the sponsors of the pension plans, are either insolvent or close to insolvent. So this is causing a huge problem across the board. Earlier, our moderator made reference to the nest egg. The nest egg concept in the US is, where do you have your money that you're saving for retirement? Some people think the right alternative is defined contribution plans, investment accounts, which you can move with you when you change jobs. And in the US, these are called 401k plans, after the line in the tax code, which permits them to exist. They're very popular. The employer decides how much salary you can set aside, and maybe the employer matches your contribution. You put in 5%, they put in 5%, to provide an incentive to invest. However, up until recently, the employee has had the opportunity to decide how much to save. And maybe zero was an option. So the challenge is the employer designs the plan and offers the plan. What if no one accepts and invests in it? Typically in these plans, the employer designs the investment portfolio, the investment menu, and it's up to the worker to select the investment allocation. Now remember back to the financial illiteracy numbers I mentioned a moment ago. If I give you 17 funds and you don't know what risk diversification means, what do you do? And this is a big issue. Now by definition, defined contribution plans are not guaranteed. That is, you invest in the market. If the market drops, so does your nest egg shrink. Now, if everyone was rational, which I'm sure everyone in this room is, you would always balance return and risk. You would make independent judgments. You wouldn't listen to what your next door neighbor says. You would always diversify your portfolio, hold at least 30 different stocks, if not a mutual fund, and you would pay very close attention to fees. This is the rational investor. What do people really do? It's very different. Behavioral economics is now showing us that there's a tremendous amount of inertia. Typically, people will pick one portfolio allocation when they're hired and never change it for 40 years. They forget about it. They also have too much choice. So they say, okay, someone told me diversify, and I pick the top 3 on the list and give up after that. But if the list was ultra risky fund, very risky fund, extremely risky fund, then you really haven't accomplished anything. They follow the herd. They do what everybody else does. And in the US, it's possible for people to put 100% of their pension account in one company stock, their own company. Extremely bad idea, but it's still possible. And they ignore the fees. So what do we do? Initially, very few people, a third of the people, were investing in these accounts. So instead, the new model is automatic enrollment. Everybody is included in the plan unless they opt out. And we find that 90% participate and no one drops out. They know they should do it. It's just too hard and too complicated to figure out how to do it. But still, many people leave their assets in cash forever. At the moment, maybe it's not so bad given the way the stock market is performing, but still they don't pay much attention to it. And this is a model which has been adopted in many countries, the notion of target maturity dates. So if you're a young person, you say, okay, I think I'm going to retire around the year 2050. So right now, I join a 2050 fund. It's heavy in equity and very little fixed income. And as I get close to my target maturity date, the fund manager reallocates and rebalances the portfolio for me automatically. So that as I get close to retirement age, then it becomes less risky and more conservative, so I don't lose the money right before I retire. So this is a very popular model in Chile, in Sweden, in very, very numerous countries. A question I hear very often in the defined contribution model is, what about guarantees on investments? People think wrongly that guarantees are free. Now, one choice might be what we call a principal guarantee. That is, if you put your money in the fund, can you get back at least what you invested? That's a principal guarantee. That is not the norm in many pension plans now. You put your money in and you get whatever you get. In Japan, however, they do have a requirement that a principal guarantee be one of the investments offered. You don't have to choose it, but it has to be offered. In some countries, they have a minimum return guarantee or a minimum benefit guarantee even, which is interesting because these are defined contribution plans, not defined benefit plans. But we have to beware because guarantees are not free. In fact, they can be very, very expensive. So with one of my students, I looked at the cost of providing a principal guarantee, just you get your money back, what you invested. And this was a portfolio that's half stocks, half bonds. You hold it for 40 years, you invest for 40 years, and that's basically free. So it doesn't cost much to provide over 40 years a principal guarantee. What's expensive is a bond guarantee. So if you want to guarantee that your investors get back a bond return over 40 years, and you let them invest 50% in stock, it will cost about 16 to 20% of each contribution every year to provide that guarantee. So this tells you that guarantees are not a small thing. The next level I wanted to talk about was political, national retirement risk management. A little bit in less detail. Here we have the risk of market shocks, inflation, and most importantly for retirement is what I call political risk. How do you know today what the tax rate will be tomorrow? How do you know today what the health care costs will be You don't. And that political uncertainty is also driving a big part of retirement risk. What do? Ideally, we have good governments with steady fiscal and monetary policy. And another option, of course, is risk financing, where we spread risks of political uncertainty over time. That, unfortunately or fortunately, is what we see now with government deficits. Now, this leads me to a discussion of a national old age Social Security retirement scheme. Almost every country has one. Every country tries to balance two aspects, two tensions. The insurance aspect, where you get back more if you pay in more. That's insurance. Versus the redistributive or the solidarity aspect, where poor people get back more because they need it more. And those two tensions persist in every retirement system at all points in time. Sometimes one dominates, sometimes the other dominates. Now, in a pay-as-you-go scheme, such as we have in Social Security in most of our countries, it works as long as you have economic growth and growth in the workforce. So let's imagine we start out with Generation Zero. Generation Zero, who was around when the system began, paid no tax, but they got a benefit which was provided by current workers. So current workers get a benefit provided by, current retirees get a benefit provided by the next generation. The next generation is happy to make that transfer. Why? Because they will get more in the future from the generation after that. So this kind of intergenerational pay-as-you-go financing works very well as long as you have growth, a rising workforce, rising productivity. Everybody's happy, right? But now we're in a different world. The tax base has stopped growing in many countries. In fact, with low fertility rates, maybe even it's shrinking. So Japan has the most rapidly aging population in the world, and the economy has not been growing. In that instance, the first generation is happy. The next generation, okay, fine. But each subsequent generation is getting less and less and less compared to what they expected. And that's the situation that we're in right now. In other words, the internal rate of return on contributions was almost infinite at the beginning of the system. The first generation paid in almost nothing, and they're getting back a lot. But as you go through time, they're getting less and less. In fact, it's so small, you have to expand it with a microscope, and you see that on average, it's less than 2%. So if people are getting such a bad return, I'm often asked, why don't we just invest the money? In other words, why do we continue this pay-as-you-go system where people are getting less and less through time? The problem is that we have an obligation to today's retirees. Most of the money today goes to pay past generations who got a good return because they paid little and got a lot back, but there's no money around to invest unless you stop paying today's retirees, which is politically very unlikely. And so you need some kind of transition financing to move away from an old age pay-as-you-go scheme toward a funded scheme. Now, of course, all of us are facing exploding pension costs. Here we have the public finances, the pension expenditure as a percent of GDP. US is around 6%, UK, Spain up here, Germany, Greece, and Italy, I think already, 15% or so. So these exploding pension costs are already in place before the population is very old. Part of the reason is the benefits are quite high. Not in an absolute sense, but as a percentage of average income. So this is Western Europe, and this dotted line refers to the 50% replacement rate measure. It's not a gold standard, it's just a number to compare it to. In the US, our typical Social Security benefit is about 40% of average wages. And here I understand that some of the recent reforms have reduced the rate to what, about 55% from something I was hearing. So it's still very high. Italy is still well above what some of the other countries have been offering. Eastern Europe, quite high. Even Asia has quite high benefits. So we're all in the same boat together. Now, of course, retirement ages have to rise. There is no way to finance such high benefits with a shrinking workforce. And it's happened in some cases. Italy has already raised the retirement age somewhat. Unfortunately, France has had a very difficult time trying to push through increases in retirement ages. There was an effort, and then I understand recently that Mr. Hollande, the new head of France, has reversed the retirement age increases. And this leads to huge protests. In Barcelona, I was there 2 years ago, and the response to the Prime Minister's effort to raise retirement age from 65 to 67. We also have, of course, France. They wanted to stick at 60, and they're going to be able to return to that. And even the kids are worried about pensions today. All generations are beginning to fight these changes. I'm 84 and mad as hell, as she says. In the UK, the policemen say their pensions are being stripped and they're ending up with nothing. And in the US, the seniors occupy Chicago with the same complaint: don't cut my pensions, don't change anything. Meanwhile, what are the international organizations telling us? The governments must continue reform to ensure that income is socially as well as financially sustainable. So this brings us to the top level of the discussion. What are we going to do about global retirement risk management? It's not about Italy. It's not about Greece. It's not about the US or Germany or France. We're all aging together. And I think this is an important point. 20 years ago, the finance guru said, oh, all you have to do is diversify your portfolios. You'll be fine. So you have countries with different economic fortunes. One goes up, one goes down. That's not true anymore. We're all aging, and there's no way out of this. And global retirement risk management would refer to things like global aging, epidemics, worldwide asset meltdowns. Unfortunately, there's not much you can do about that. We're all in the same boat together. In fact, the only way that you might be able to spread global risk is through time. But the only way you can spread global risk through time is with unfunded pay-as-you-go systems, which we just saw got us into a lot of trouble. So there really is no good answer at that level. And demographic change is marching on. Western Europe, this is the fraction of people age 65 plus to the population younger than 65. Western Europe here, all of Europe, Eastern Europe, even Asia, because of especially the one-child policy in China. They're aging very quickly before they're getting rich. It's quite a challenge. All around the world, total longevity, life expectancy is going up. Fertility rates are going down, somewhat different between developed and less developed countries, but we're all heading the same direction. And the medical journals now say, actually, 100 is young. We're all going to live in the future to 110. In the UK, they're now using 125 as the outermost year to calculate life expectancies and pensions. Well, I'll get it later. So just to illustrate, last couple of slides, what this will mean visually. This is the percent of the population 65 plus in the year 2000. And you notice the white countries have less than 7.5% old. And as it gets darker and darker, the fraction of people over the age of 65 goes up. And right now, Europe is leading the way in successful aging, or perhaps unsuccessful aging, but no country has this blue and white color indicating 30% or more. So the demographers make a projection. What will the world look like in 2050? And the world is going to be very, very different. This is the fraction of the world that will have 30% or more of the population over the age of 65. There's very little geographical opportunity for diversification, with the exception maybe of Africa, which has lots and lots of other problems. So, where does that leave us? Well, I'm sure I've depressed you. That's what economists do. And if you just heard George Soros a moment ago, that was even more depressing. What can we do? What are the opportunities here? I think we have to reinvent retirement. At the turn of the previous century, in the year 1900, people didn't retire. In the year 1900, the life expectancy was around age 40. Hard to believe. And people worked in the fields if they could. If not, they worked at home taking care of the family, but they worked until they died. Then we had this middle class phenomenon of retirement throughout the 1950s, 60s, 70s until now. I think retirement has to be reinvented again. We obviously have to invest much more in financial literacy. We have to build our human capital, a theme of this conference, build our families, build our communities. We're going to have to save more, invest smarter, protect against longevity to the extent we can pass that on through financial products, work a lot longer, maybe make home equity accessible, and restructure pensions. So just to make sure you're not too depressed, I leave you with a small cartoon. Here's the financial advisor. He's talking to his clients, an older lady, an older man. He says, I had to make some adjustments, so your new retirement date is 2065. And that's the future that we have. So thank you very much. We have two books I wanted to mention, both of these with a role by Ana Maria Luzardi. This one is our new book on financial literacy. This one is Overcoming the Saving Slump. And we have a website, which I encourage you to access, and a blog that Ana Maria has successfully launched. So with that, I'd like to stop, take your questions, and I appreciate your attention. Thanks.
Thank you, Professor Mitchell. While I'm still, in order to give you a chance to put forward some question or to send a piece of paper with a question on it, maybe I can put some first question to Professor Mitchell. That is, in your last chart, you didn't have the politicians to reform. So. Populist politicians who try to do shortcuts not for 2050 but for 2013. So I'm personally from the generation of the baby boomers, and the rational thing would be to have in my country a reserve fund for a supplement of money when these baby boomers need some pension. But politicians think it's better pay more now. Pay more money to pensioners now because you get maybe more votes. Or a more complicated example could be it all depends also on tax. If you have low spending by the state, you have low taxes. But if you have a politician who says, I will spend now, take out debt now, and tax later, so this is when generations that are working now will have maybe less pensions and even have to pay a debt. So the question is, how do you integrate the politicians in this picture, and then is, what is the question that journalists, economists, literate economists, literate literate consumers should put to those politicians to put on their piece of paper in a demonstration to say that maybe they are cheating right now for the future, but maybe people are not literate enough to see through until 2050.
So the difficulty with trying to change politicians' minds, as you correctly note, is politicians have a short-term focus, and they want to get reelected. And the best way to get reelected is to promise much and not tax very, very much. I think one of the problems with pensions, too, is that they're very complicated. The accounting is complicated, the financial issues are complicated, but people whose job it is to represent us can be forced to make these more transparent. So, for example, if a city, the city of Philadelphia, where I live, has a pension fund that is about 34% funded, not very good. And they're projecting big increases in the future. However, the city is also facing a recession. They have not enough taxes to deposit into the pension fund. So instead of depositing the money to secure the teachers and the police and the firefighters' pension fund, instead the mayor, who went to my school, I like him very much, but the mayor said, it's too expensive to fund the pension. So instead of amortizing the obligation or filling the debt over 20 years, which is the current rule, we'll extend it to 40 years. So we have twice as long to fill the debt. But the problem is, this means that consumers are consuming today police services, firefighter services, garbage collection services, teacher services, and they're passing the bill to my grandchildren. So the pricing is absolutely wrong in this setting. And my view is that it's possible to do a better job if we force the politicians to report the long-term cost consequences of what they're doing today. A different way that the markets might work is that if we realize there's a lot of pension underfunding, this can have an influence on property values. So it has been demonstrated in some research that regions or cities that have very underfunded pensions, this is capitalized in the value of the land, because they know sooner or later the taxes will have to rise to be able to capture the needed money. So you don't really escape it. It's just hidden. It's like the shell game with the peas. It's there. It's just hidden.
If I put another question, so in this case, it's too simple to say you just put a zero deficit role as the Europeans put in. What would you like as a rule? Well, European countries have now had this agreement to put a zero deficit rule in their constitutions. But maybe you want a different sort of rule in a constitution, if you look also at the long-term consequences.
I think the issue is not what's in the Constitution. I think because there's always smart people that can get around the rules and regulations with different financial products or different kinds of mechanisms. I think that, to be honest, a defined contribution scheme where you, the employee, have responsibility for contributing, for investing, and for paying out is much more likely to capture people's attention and to make them understand they're responsible for themselves. I think it's almost inevitable that a government-run public pension is going to suffer these political tensions and will be mismanaged.
Are there any examples that you would like to tell us of a very catastrophic or a very innovative way that countries or communities have adopted?
Too many catastrophes are available. Argentina was a case where they stole all the assets of the pension fund. Not a good model. A good model, I think, is perhaps Australia. In the country of Australia, they have a national mandatory pension scheme where you must invest 9% of your salary every year. You have choice on where to invest. There's some ample choices. And if you move from one employer to another, it's still your money. You don't leave it behind. So the pension does not retard mobility. The pension makes mobility feasible, which it should be. Did you have a question?
Questions?
The back? No.
I think
Buonasera, volevo sapere.
Good evening.